If you're 65 or older, you need to drop whatever you're doing right now and listen closely, because there is a massive chance you are handing the IRS way more of your retirement savings than legally required. Look, transitioning into retirement flips the entire tax system upside down. You stop working a W-2 job, you start living off Social Security, and suddenly the rules change completely. But nobody gives you the new rule book. The IRS is never going to call you up and say, hey, you missed a massive senior tax break, here's a refund check. No, keeping your own money is 100% on you. So today, we are fixing that. I'm breaking down 4 highly valuable tax deductions and credits available right now for retirees. And you absolutely must stick around for number 4 because it's a brutal hidden tax trap that completely blindsides thousands of seniors. Let's dive straight in. Number 1, the additional standard deduction. Most people know about the regular standard deduction. It's just a flat number that lowers your taxable income. But here is the secret the government doesn't advertise. The IRS actually gives you a bonus deduction just for getting older. If you turn 65 by December 31st, you legally get a higher standard deduction. And if you are married filing jointly, it gets even better. Once your spouse also hits 65, you get 2 extra standard deductions stacked right on top of your regular one. So why do millions of seniors miss this free money? Blame it on DIY tax software. If you accidentally skip the box asking for your exact birth date, or if the system glitches and forgets to check the over 65 box, poof, that deduction is gone. Period. Even human CPAs make this ridiculous mistake constantly. So this year, look specifically at the standard deduction line on your return and verify you got that extra bump. It is literally free money shielding your hard-earned pension. All right, moving to number 2, and this is huge. We are talking about a tax credit, not just a deduction. The difference between those 2 words is massive. A deduction lowers your taxable income. So a $1,000 deduction might only save you $100 total. But a tax credit wipes out your actual tax bill dollar for dollar. A $1,000 credit means you pay exactly $1,000 less in taxes. It's infinitely more powerful. And the IRS has a specific one. It's called the credit for the elderly or the disabled. To qualify, you just need to be 65 or older with a relatively low adjusted gross income. But here is the absolute tragedy of this entire situation. The seniors who actually qualify for this are usually the ones who desperately need the cash, yet they are the most likely to miss it. Why? Because you have to file a highly specific, easily overlooked piece of paper. It's called Schedule R. If you take absolutely nothing else away from this video, write that down right now. Schedule R. If you live on a modest fixed income, don't just assume your accountant did their job. Ask them point blank, do I qualify for the Schedule R tax credit? Make them check, because nobody cares about your retirement budget more than you do. Now, let's talk about where seniors bleed the most money needlessly. Let's talk about number 3, medical expenses. As we get older, healthcare easily becomes one of our biggest monthly bills. But the IRS actually throws you a lifeline here, provided you know exactly how the math works. Here's the rule. If your out-of-pocket medical expenses go over 7.5% of your adjusted gross income, you can deduct everything above that threshold. Let's make this simple. Say your income is $50,000 a year. 7.5% of that is $3,750. So any qualifying medical bills you pay past that number can be deducted. Now, I know exactly what you're thinking. I didn't have any major surgeries this year, so I definitely don't qualify. Stop right there. That is the single biggest misconception out there. It is not just massive hospital bills. The list of eligible expenses is absolutely massive, and it includes your everyday costs. We are talking about your Medicare Part B and Part D premiums pulled straight from your Social Security check, your Medigap premiums, out-of-pocket prescriptions, dental work, which Medicare usually ignores, hearing aids, and even home modifications for aging. Things like installing a wheelchair ramp or grab bars count. And get this, you can even write off the mileage on your car when you drive to the doctor's office or the pharmacy. It all adds up incredibly fast. When you start combining those premiums, co-pays, dental visits, and the gas you use driving to get your pills, you will cross that 7.5% threshold before you know it. Track your mileage, keep receipts, and show your CPA. Finally, we arrive at number 4. This is the big one, the one that absolutely infuriates retirees. I call it the Social Security tax trap. Most people assume that because they paid into the system their whole lives with after-tax money, their benefits will be tax-free in retirement. I hate to break it to you, but that is flat out wrong. Depending on your overall income, up to 85% of your Social Security can be taxed federally. Here is how the trap snaps shut. The IRS calculates something called provisional income. They take half of your Social Security and add it to your pensions, part-time work, or traditional IRA withdrawals. It creates a sneaky ceiling. Imagine you need to fix a leaky roof or buy a reliable car, so you pull a quick 20 grand from your traditional IRA. You already know you owe taxes on that withdrawal. But here is the kicker. That extra cash just pushed your provisional income over the invisible IRS limit. Suddenly, the Social Security checks that were totally tax-free are now getting taxed. You essentially get double taxed for making a single necessary financial decision. This is exactly why tax preparation looks at the past, but true tax planning looks at the future. By strategically managing which accounts you pull from, or doing Roth conversions early, you can legally manipulate these income limits. You can completely protect your Social Security from being raided by Uncle Sam. You worked way too hard for decades to build your nest egg, so don't let the government take more than their fair share. Here is your homework. Before the next tax deadline, sit down with a pro and bring up the extra standard deduction, Schedule R, the medical threshold, and your Social Security strategy. Do not leave this to chance. And if you are sitting there realizing you might have missed these exact deductions over the last couple of years, take a deep breath. You can still file an amended return using Form 1040-X to get a refund. Quick disclaimer, guys, this video is for educational purposes. Everyone's financial puzzle is completely different, so please don't treat this as personalized advice. Always talk to your own advisor about your specific situation before making major money moves. If you found this valuable, do me a huge favor. Smash the like button, subscribe so you don't miss our upcoming retirement tips, and let me know in the comments. Had you ever heard of Schedule R before today? Take care of yourselves, protect your hard-earned wealth, and I will see you in the next video.